What if you could secure your financial future with the same precision you use to secure a mission? These 3 strategies can do just that. Markets are unpredictable, but your future doesn't have to be. Today, we're breaking down 3 of the safest investment strategies for 2025, tailored specifically for military members and veterans. Here's the mission brief. First, we'll look at government-backed savings plans and why they're a cornerstone for stability. Then, we'll explore diversified index funds and ETFs to balance risk and reward. Finally, we'll tackle real estate strategies like REITs and VA loans to build long-term wealth. And stick around, because at the end, I'll expose a common mistake that could quietly derail your financial growth. Let's dive in. I'm not a financial advisor, just a veteran sharing what worked for me to give you a hand up and not a handout. Strategy number 1, government-backed savings plans. Let's start with a reliable option, like the Thrift Savings Plan or the TSP. If you've served, you probably heard of the TSP, but what makes it so powerful is the range of funds it offers, designed for different levels of risk and reward. Take the G Fund, for example. It's often considered the safest zone, backed by the US government, to provide steady returns without exposure to market volatility. It's perfect for those who want to prioritize stability over high growth. And on the other hand, the C Fund mirrors the S&P 500, offering exposure to large US companies, while the S Fund focuses on smaller, high-growth opportunities. By diversifying across these options, you can balance security with potential for higher returns, tailoring your investments to fit your goals. Strategy number 2 is diversified index funds and ETFs. Next, let's talk about index funds and ETFs, the building blocks of a stable and secure investment portfolio. Think of these as your strategic supply drop, ensuring you're covered no matter how the market shifts. These funds are like spreading your gear across the battlefield. If one position falters, others steps in to keep the mission steady. Let's start with the S&P 500 index. This fund tracks the top 500 companies in the US, representing a broad range of industries. By investing in the index fund, you own a tiny piece of each of these companies, essentially spreading your bets across a wide terrain. This approach minimizes your risk compared to putting all your resources into a single stock. But what exactly is an ETF? Picture this. You're assembling a tactical kit for a mission, right? Instead of choosing one tool, you'll pack a multi-purpose kit with everything you might need. That's an ETF. It's a collection of stocks or bonds bundled together into one fund that you can buy and sell like a single stock. Many ETFs track indexes like the S&P 500. So when you invest in one, you gain instant diversification and a stake in the broader market. Why are index funds and ETFs lower risk? These funds lower your risk because they spread your investment across multiple companies. It's like deploying a squad instead of relying on a lone operator. If one member has an off day, the rest keep the mission on track. Got it? Plus, ETFs are professionally managed to follow specific market indexes, ensuring your investment stays aligned with the market's overall performance. Think of it as having a commander who continuously assesses the battlefield to keep your resources secure. Why include both in your strategy though? Because index funds and ETFs work together to provide both stability and growth. Index funds are great for those looking for long-term steady growth, while ETFs offer the flexibility to trade during market hours, making them dynamic for short-term adjustments. Whether you're in it for the long haul or adapting to changing conditions, combining these two can give you a well-rounded and resilient portfolio. I remember when I first started investing, it felt like I was navigating unfamiliar territory. But when I discovered index funds and ETFs, it was like finding a reliable map and a versatile toolkit. They gave me confidence that I wasn't relying on one stock or company to carry my future. Instead, I had a balanced approach that made me feel secure no matter what the market threw at me. Strategy number 3, real estate investments, REITs and VA loans. Real estate is another strong move for building wealth. You've got 2 main strategies: invest in REITs, which are real estate investment trusts, for steady passive income, or use your VA loan benefits to step into home ownership. And let's break it down. REITs, or real estate investment trusts, are like owning a slice of a mission without being boots on the ground. Imagine investing in commercial buildings, apartment complexes, or even hospitals, all without having to deal with tenants or repairs. REITs pool money from multiple investors to fund these projects, and in return, they pay you dividends, regular income that's handoff and steady. REITs come in 3 different flavors. You have the equity REIT. These invest directly in properties and generate income through rent. Think of it as earning rent without managing the property. Then there's the mortgage REIT. These focus on property loans, earning income from the interest on mortgages. And last but not least is the hybrid REIT. It's a mix of the two, giving you exposure to both properties and loans. One of the biggest advantages of REITs is liquidity. Unlike owning a property, you can buy or sell shares quickly on the stock market. It's like redeploying assets whenever the situation changes. Plus, by law, REITs are required to pay out at least 90% of their taxable income to investors, making them reliable for steady cash flow. Now, let's talk about VA loans. It's a benefit tailor-made for us. A VA loan isn't just about zero down payment. It's a tactical advantage in the financial battlefield. Here's why. No PMI, private mortgage insurance. That's a monthly cost civilians often pay, but VA loans eliminated, saving you hundreds of dollars annually. Flexible credit requirements. Even if your credit score isn't perfect, VA loans are forgiving. Lower interest rates. Compared to conventional loans, VA loans typically offer better rates, saving you money over the life of the mortgage. Limits on closing costs. This ensures you're not overcharged during the buying process. And foreclosure protections. These are safeguards in place that help veterans avoid losing their homes during financial hardships. Here's the big picture. Owning a home builds equity, a financial asset that grows as property values increase. It's like fortifying your position over time. You're not just paying rent, you're investing in your future. And with the VA loan, you can also refinance down the line to tap into your equity for other investments. Now, let's compare the REIT and the VA loan. Here's the tactical choice. REITs are great if you want liquidity and passive income without managing a property. It's like supporting the mission from a command center. VA loans are ideal if you want stability and equity for the long haul. Boots on the ground in the real estate market. Which strategy do you think aligns best with your goals? TSP, index funds, or real estate? Let me know in the comments. Your experiences could help others. Remember when I mentioned common mistakes? Here's one I've seen too often. Not diversifying enough. Putting all your money into a single fund or property might feel safe, but it leaves you vulnerable if that asset underperforms. Diversification spreads your risk and ensures stability across all fronts. Even with these strategies, there's a critical mistake most veterans make that quietly erodes financial growth. And the next strategy I'm sharing can completely reshape your retirement income in 2025. It's a tool that's redefining financial planning, and if you're not using it, you're falling behind. I'll walk you through it step by step right here.